good to go. Okay. So good afternoon, everyone. Thank you guys so much for spending such a beautiful Friday afternoon to be here with us. So we are Team 3 and we're excited to be here for the CFA Ethics Challenge 2023. So here are our team members. So we have Jackie, Pramit, Siddhan, and me here. Kosen cannot be here for some personal reason, but we promise to bring you a great presentation today. So today we're going to look at the conversation between some key members in the Lokhandi Capital organization. So we have here the CIO, Chief Investment Officer, Courtney McBride, and two portfolio managers, including Newbridge, and then Sportboot, together with the sales assistant, Sarah. We're going to analyze this case based on the key CFA ethical standards that have been violated, including professionalism, duty to client, duty to employees, investment analysis, recommendation, actions, and conflict of interest. So let's get right into it.
So good afternoon, everybody. So I'm going to talk about the first conversation, and in the first conversation, the first part was about some undisclosed changes in the fund strategies. So the portfolio manager was not getting good returns, so he changed his strategy from basically investing in large cap stocks, blue chips companies, to a smaller and unquoted companies. And he thought that it is not recommended, or you should not present it to the clients, or you should not inform the clients about the strategy change. So we think that's the first violation, that the communication with the clients, which is standard 5B, is he has breached that. And we also think that the IPS statements also changes because the investment actions and the processes changes. So that's one more violation done. The third one is that when he changed from investing in large cap to smaller cap, he didn't have a reasonable biases of research. So I think that's also one violation. And if I'm talking about the CIO McBride, he had basically agreed with the fact that telling to the clients it does not require, you do not require to tell it to the client. So that's a violation on the responsibility of supervisors. So some alternative courses of actions will be that anytime any strategy is changed, there should be a full research done. There should be proper communication given to the clients, and in terms of supervisors, they should see that nothing unethical is happening in the company, and everybody is following the rules of ethics. Now I'm going to talk about the second part of the violation in that first conversation, and it is basically when he started investing in the unquoted companies, unliquid companies. He basically was breaching a regulatory ceiling, but he basically managed that by doing a share asset swap with another fund he manages. So we think, first of all, it's again the communication violation which he has done. He's not making this proper disclosure to the clients. And the second violation which he has done is fair dealing, where he's not treating both the fund clients in an equal way, because he's taking out the liquid assets and putting it in another fund, and vice versa. And again, CEO McBride was not having a issue with it. So we think that the violation of responsibility of supervisors comes in this way. In the first conversation, this was the third violation, was basically because he was not doing well. He was planning to close down his fund. So the CIO McBride told the portfolio manager that we should tell our biggest client first, and then give an announcement that we are closing the fund. And this is basically it is a violation, because you're not fair dealing with the clients. You're telling the biggest client first, and then you're telling the other clients. So we think that first of all, there's a fair dealing violation done, and to improve that, there should be an equal representation and equal communication given to everybody together. And the second violation is the knowledge of law, because McBride said that we should tell the client first before other clients. Sportswood knew about the violation, but still he agreed to it, and we think that because he's a CFA charter holder, he should have dissociated himself from that action, and he should have gone to the ethics department. Thank you.
Thank you, Siddhan. So I will be speaking between the conversation of CIO McBride and the new portfolio manager, Newbridge. So Newbridge basically tells CIO McBride that he has been contacting clients 2 weeks before his resignation, and that's how he has so quickly able to transfer his past clients from his past employer to his new employer. So this puts him in violations of, firstly, loyalty to his employer. Sarah, his personal assistant, who was with him, who came to the new position with him, also violated loyalty to his employer. Sarah has also violated the standard knowledge of law, and CIO McBride, knowing full well, should have tried to prevent portfolio manager Newbridge to not solicit clients 2 weeks before their resignation, so she has violated responsibility of supervisors. Moving ahead, the alternative course of action for them would be to contact clients after their resignation period is over, since they have not signed any non-compete agreement. And Sarah, knowing, should have disassociated from any unethical violations from Newbridge. Moving on to the second part of the conversation, Sarah and Newbridge basically use the same predetermined information to sign blank account opening forms. So that puts them in violations of loyalty, prudence, and care towards their clients, suitability towards their clients. Sarah again violates the standard knowledge of law, and CIO McBride again violates the standard regarding responsibility to supervisors. To stay in compliance with these standards, Newbridge and personal assistant Sarah should basically put their clients' own interests above their own personal or the employer's interests, and they should dig deeper into the client's investment and risk objectives relating to the standard suitability. So basically, McBride gives portfolio manager Newbridge some good news that Fortescue Capital has been looking to invest $10 million into his new fund, provided he can make 3 round-trip trades each month. So this puts Newbridge into violation regarding conflicts of interest, specifically referral fees and disclosure of conflicts, and he is also participating in those activities with McBride, who is the CIO, and therefore that puts him in a violation of knowledge of law as well. To stay in compliance with these violations, he should disclose such an arrangement to all the other clients in the firm, especially the referral fees. Moving on, Newbridge asks McBride if these round-trip trades are allowed according to the prospectus of the company, and McBride responds by saying that yes, this is in compliance with our prospectus because it is put in place for institutional investors. That puts McBride into a violation of fair dealing and communication with clients and prospective clients. Yeah.
All right. So with so many violations in place, it's very clear that a point solution to each of these violations is not sufficient, it's not sustainable. And that's why we came up with this 3-layer simple strategy, beginning with the on the firm level that can apply across the firm, and then procedures for the investment team, I think, were tailored for what we have identified in the case, and lastly, there's some general controls and conducts that we think could apply to increase individual accountability. So specifically on the firm's perspective, the firm's wide solution, we have 3 backbones with a code of ethics, just establishing a referenceable guide, a body of standards for the charter holder and the firm as overall, and then provide these great informations to the key parties through regular ethics trainings with our new employees and also existing employees. And lastly, maintain an anonymous whistleblower hotline so that we're able to execute and enforce these standards of conduct. On the other hand, with our investment team's procedure, we have tailored design for this case. We designed multiple procedures across the investment cycle, beginning with the account creation cycle, with the IPS creation and multiple levels review for it, and then daily operation of the fund, and later on with distribution and eventually closing the fund. Happy to talk about more about these in the Q&A. So overall, we're able to provide a comprehensive plan with what we just talked about. Just before we close, I want to end with a quote. If you're not serving as a great example, very likely you're serving as a horrible example to somebody else. So the importance of is being a good example, and the critical part of that is to have a detailed idea of what you have done wrong and what you could be doing with a plan.
That's time.
And that's what we're proud of. Thank you.
We'll now have 5 minutes of Q&A by the judges.
Okay, I guess I'll start on this Newbridge and Marco. Did you find any say misconduct or I guess inappropriate behavior when you look at just their uploading of the cloud information?
No, because there was no dishonesty or fraud involved, and it did not compromise the reputation of the firm or their professional activities.
Okay.
One thing I would say is it's not really clear in the case, but if they're taking directly the files from their employer, that file belongs to their prior employer and they need to ask for permission. And usually taking the property of the employer to the next employer is a misconduct. So if that's what happened, then that would be a misconduct.
I guess overall, just at the Spotswood situation, did you notice any I guess any misconduct in their professionalism and how things are handled?
Yeah, so if you're talking, I think first of all, they should be more open and they should have a proper stream of communication when they are basically doing any strategy change to the clients. And I think that was the main case everywhere in the case where they were doing a lot of changes in their strategies and doing a lot of activities on investment actions, but they were not informing the clients and the stakeholders. So I think that was one of the main crux of this case, and we think that if that relates to misconduct, then that can be called as a misconduct, but I think that it's more related to the duties of clients and employees in this case.
And just to add on to it, by doing so many things that violates the general ethics of CFA standards, it reflects badly on the professional overall. So I would say for professionalism, that's one violation there, just by not following the general ethics that normal people should have.
So in the last part of the story regarding New Horizon Fund, if they agree to let one investor to market time, for the fund, do you think that creates any sort of conflict of interest? And if so, can you elaborate?
Yes, it does create a conflict of interest because speaking specifically, their independence and objectivity has been compromised. So it is their duty to disclose to other clients this arrangement with Fortescue Capital.
In regard to the ongoing continuing education oversight, even implementation of procedures should have been in place already. Aside from more, and I'm not saying your presentation included this, kind of very basic oversight, ethics training and the like, which is wonderful on a continuing education basis, but I did not hear anything as to active investment oversight, where you have a independent, if you would, portfolio manager or compliance officer, because of the pattern that started when they came over from the first firm, obviously took root in the new firm. Just make sure this did not happen, because as practitioners, we know that if that happens, the firm goes out of business.
Yeah, that's a wonderful point you brought up, and just because of time, we're not able to talk in detail. But part of the daily operation, what we come up with is having this holding and trading risk report, so to understand for your trading operation, also from a compliance perspective, the holdings, if in any way they have been breaching the regulatory ceiling. And we have this scheduled risk review with the supervisor of the fund, so he can overview these reports. And lastly, he will have this quarterly interview with the compliance team. So both the supervisor and compliance team will work together to ensure the compliance side, and that's kind of the detailed solution we came up with.
This is well done. This is what I was speaking to.
Yeah.
To have had the time to digest that, I know it's a very compressed
Yeah.
time frame. You
Yeah.
have a lot of work to
Yeah.
get across, a lot of research,
Yeah.
analysis to get across in a short period of time.
Mhm.
But this basically would serve any idea of template
Yeah.
for continued oversight. Thank you.
Thank
That's
you.
time.